All right, good morning and welcome to another edition of the Main Management Weekly Market Note. This is for the week ended December 19th, 2025. Hope everybody, or at least us in NorCal, are staying dry. We're in the middle of our atmospheric river,
Mhm.
which has failed to deliver snow to Tahoe. Fingers crossed that it starts happening. I think Mammoth's getting completely missed.
Mm.
In the meantime, if you're out around us, stay dry and safe. And the rest of you, hope that the weekend was great. Let's get into it. Here's our real quick, our offerings, as usual, are for ETFs. The performance for the week was more down than up.
Mhm.
I think people were kind of hoping that the Santa Claus rally would start to materialize. I've seen a couple of pieces saying that they kind of thought that the Santa Claus rally was a bit drawn out this year and
Mhm.
started back kind of maybe the third week of November. And it's been up, what, like four and a half
Yeah.
percent since then, I think. So that's where they're kind of saying, all right, we already kind of got the rally. The timing is less of an issue, but generally it also comes later in the month. So maybe it's the last
Mhm.
2 weeks here. I don't know, we got what, 7 trading days left.
Yeah.
So we'll see. But on the sectors, consumer discretion, tech leading to the upside, energy really kind of fallen out of bed. Oil hit 5-year lows last week, and that sector is very highly correlated with oil prices. So that's no surprise there. And then for the broad market indices, Nasdaq up 0.6, Euro stocks up 0.3, and the laggards were developed markets and small caps. Year to date, the only sector in the red is real estate. The rest are positive, and then all of the kind of broad indexes in the top left square there are positive year to date, led by Euro stocks at 34, and then bonds quote lagging at 3%. Recession dashboard, not a ton change last week. This was pretty static, just admittedly, because there is a lack of data due to the government shutdown and the stuff we've gotten. We're about to get into. You'll see the non-farm payrolls were finally released this past week for October and November. Kind of a downside surprise in October, shedding 105,000 jobs, which is the most since December of 2020. But then November came back with 64,000 jobs. So you can see that blue line is kind of the 6-month rolling average, and it's just trending lower. And I think we're still trying to figure out what the break even rate is. And so until we kind of, I don't know, get a couple more months of this,
Mhm.
especially when you have lack of data,
Yeah.
incomplete surveys,
Noisiness. Yeah.
that I think we need to get into 26 and get a couple of readings there to see where things are kind of stabilizing. But the labor force is up by 323,000, which is good. Household employment up by 96,000. The U rate, unemployment rate, jumped to 4.6. That was above forecast for a 4.4 reading and the highest since September of 2021. So that was a little downside surprise there. But the participation rate was also up. It's up to 62.5. Wages slowed to 3.51%. That's the smallest year over year since May of 2021. We touch on that in a minute here too. But it's kind of just more moderation in
Mhm.
the labor market. Not a ton of surprise here. Kind of some good aspects, some bad aspects. You kind of
Yeah.
pick which ones you want to support your story and run with that.
Yeah.
On the kind of looking under it on the left, we show the unemployment rates. The dark blue line or black line, depending on how good your eyesight is up to 4.6. That is the headline U3 rate. That was well above forecast for 4.4, as we said, highest since September 21. The broader U6 rate, which kind of pulls in more like disenfranchised workers, people kind of on the margin of the
Mhm.
labor force a little bit more. So it's a bigger pool, but people who are more likely to be unemployed because there's just a little more comprehensive reading. But that's 8.7%, which is the highest since August of 2021. So not great there. You can see there was a pretty solid
Mhm.
spike this month too. But again, they're both still below their medians. And you see the way these work, they just kind of come in waves. They're not often treading water at a particular level. So you kind of get it goes up and then you hit a recession and then it drops.
Yeah.
If you go up and you hit a recession and it drops. So we're kind of on the way back up. We'll see. I think this is part of that plays into the rhetoric of people waiting for this recession that
Yeah.
is yet to materialize. But on the right, we show wages, that year over year is that blue line there. You can see just moderation. I think, it slowed to 3.51%. The month over month reading was a meager 0.14, which is the smallest since Feb of 22. But again, it's basically back in line with pre-COVID levels. And I
Mhm.
think it just kind of shows you we're 5 years on
Yeah.
and we're just now kind of touching back, moderating at pre-COVID levels. So I think the question here is, does this thing start to kind of move more sideways than down, or does it keep going down? And that's where we'll start to worry. But for the time being, with the inflation numbers we got, people are still of real purchasing power. Wages are outpacing inflation, which is a good thing.
Yeah. I'll say one thing on the U3, and I think we touched on this as well on the next slide, that a broad part of it going up was due to the denominator, the participation or number of people, looking for work going up overall, as opposed to outright job losses,
Yeah.
which is probably a more positive thing than the headline implies, but obviously still implications for a cooling labor market, but not say as bad as, everyone's getting fired or
Yeah.
everyone's losing their job.
And yeah, I think that's an important point where the participation rate goes up means people are re-engaging
Yeah.
in the labor market. You saw that labor market group of 300,000 people. That means even if they are unemployed, they're looking for work.
Yeah.
And that's an important dynamic. You don't want to see that U rate going up as the labor force is declining.
Yeah.
You want to see that labor force participation increasing because it means people are re-engaging and trying to find work. And even if they can't find it, they're still out there looking, which is better than just kind of giving up.
Yeah.
And because there's a lot of people out there who give up and they just fall out of the calculation. So they're unemployed, but because they're not looking for work, they're not part of the numerator or the denominator. So it's a little misleading there at times. But on the left here, we show the participation rate for 25 to 54-year-olds. That's kind of the prime working age cohort. That's back up to 83.8%, which, only behind July, August of 2024. That's the second best reading since May of 2001. So that's good. That's a really good aspect where the prime working age is starting to re-engage. You saw it was treading water there at, 83.5 for a while. So to get back up to 83.8 is solid. The overall rate's up to 62.5. That's a 6-month high. That thing's been trending water sideways to down. You hope to see that maybe starting to hook a little bit. And it's also worth noting that the 105K drop in October for the total figure was entirely due to government. That shed 157,000 jobs, which is the most since May of 2020. So COVID firing or layoffs, that the government was entirely responsible for the negative number. Private payrolls added 52,000 jobs, and they've added 44,000 jobs on average over the last 6 months for a total of 264,000 jobs, while the government has been a dead weight or an albatross around the neck of the private sector. What else is new there? But the average decline of minus 27.3 thousand jobs per month for a total of minus 164,000. So private sector plus 260, public sector minus 164. And that's good. You want to see the private sector kind of picking up the slack and continuing to move forward, because government is also subject to budgetary restraints and that sort of thing, whereas private sector is just, it's capitalism. It's what works. If they're profitable, they'll hire. And so seeing that continue to drive forward is good. And it's also 85% of total employment. So again, important to see the private sector kind of moving along. And we liked to see that in this report. Switching gears a little bit. So this is, coincidentally, the other side of the Fed's dual mandate. We haven't mentioned the Fed yet. What have we done? But the much delayed CPI report was also out this week. And they basically just said, October never happened. Like, we're just not going to do anything. So that's why there's just gaps in October. There's no reading, which we were kind of talking about this. And we're like, well, what's a month over month comparison for November doing if it's not compared to October? So I don't know. They have been like not very clear about how they've done this. So I think a lot of people are like, I've seen multiple reports just call the data holy. HOLEY, not given we're in the holidays, not HOLY. But the headline CPI reading was up plus 0.2% month over month, slowed to 2.7 below forecast for 0.3 month over month reading. And then core CPI was also in below expectations at plus 0.16% month over month. That's the green on the right there. And that's led to 2.62 year over year, which is the smallest increase since March of 21. So what does this mean overall? Like, the Fed has more room to cut. They can continue to say, hey, inflation is fine. We only have the data we have. We'll stick with that. It shows moderating inflation. So we're going to focus on the labor market, which in this case tends to kind of probably lean more towards cuts clearly than hikes. So we'll see there. There's a lot of time discussion on timing and number of cuts on the Fed, but that's kind of a little bit more wait and see, I think, for the time being. Within the CPI, shelter has been sticky. That's a big component. It's like a third of the CPI basket. And as you can see, that thing was up to 6-7% year over year. Has finally come back down to 3%, which is the lowest since August of 21. And it's back below, kind of in line, slightly below pre-pandemic levels before you got those kind of COVID, in distortions. And then food was accelerating for a year and a half, almost 2 years, which was kind of concerning there, but it started to roll back over. And again, a lot of the kind of analysis of this is saying this is if anything, this report will get revised up. Like, it will be more inflationary than they think. This is surprisingly cool. But again, a lot of the food prices were very easy to get the headlines
Yep.
because you saw huge distortions in like eggs and bacon. But it's eggs are now down 13%. They were up 60% back in March of this year.
Yeah.
So things have moderated. What's the saying? The best cure for high prices is high prices.
Yeah.
Uh,
One thing I know I read about on this report, there's obviously a lot of noise that happens when you kind of cut out an entire month of data.
yeah.
Kind of inevitably there are issues or kind of lower than should be readings, especially on things like shelter, where you're imputing these prices based on kind of like annual figures, all of that. So yes, the headline's noisy. Like you can't really take, it's hard to take a month over month reading for a month that didn't really
Didn't
exist.
happen. Yeah.
But I think on the headline, you look under the covers, there are some positive things, looking at food, looking at some, energy prices, things
Mhm.
like that, where, food especially is something that I noticed. You look from April to today, yes, there was a spike right after kind of April, May, June. Probably a lot of that due to tariffs on the food we're importing. But it seems to be rolling over there, at least on a kind of year over year basis. Again, maybe there's some noisiness, but even kind of looking through that, certainly seems like less pressure than there was, just 6 months ago.
Yeah, yeah, this is good to see. We would
Yeah.
like to see it, better than getting this report coming in and being considerably
Yep.
above what people were thinking. On the goods and services side, we've looked at this a bit more because of the tariffs that came in last year on the goods rather than the services. But the goods CPI has been choppily accelerating on a year-over-year basis. It bottomed at -1.3, so straight out deflation.
Hmm.
In September of 24 and is now got up to almost 2 at 195 in September of 2025, since moderated a bit to 1.8. So good to see that kind of topping out.
Yep.
Hopefully that continues and starts to roll back off as
Yep.
these kind of one-time tariff increases have passed through. But for what it's worth, that core PCE goods though got to if you exclude the COVID distortion, it got to a 30-year high. So the
Hmm.
core PCE goods has been running hot. It's almost, I want to say 2-3%.
Hmm.
So worth looking there when we get the next income and spending core PCE release. But the CPI goods basket, and this is overall not core, kind of starting to maybe show signs
Yep.
of softening. On the other side, though, services have just been disinflationary. They've been slowing down. They are now up to 3.21%, smallest increase since September 21. So a lot of these comps you probably figured out are going back to mid 21,
Yep.
just based on the year over year numbers coming out of the pandemic. But these are kind of two sides to the coin where people are like, oh, these tariffs have been massively inflationary on the goods. And you're like, okay, but services have just gone straight the other way.
Yep.
And so while you have had some acceleration in goods prices, service prices have come down and are kind of just muting the overall number.
Yeah, that's something we've talked about, is like tariffs are more like act more like a tax economically, where it cuts into that overall pie of spending, where your goods are going to go up as a portion of that pie and services are going to go down, rather than kind of absolutely changing the overall price
Yeah.
level. Yes, there will be things that are more expensive or less expensive, but on the kind of overall pie, it's not going to increase inflation all that much.
Yeah. And also the weights of services are a little more highly weighted, I think,
Yeah.
just given they're a larger part of the economy.
Yep.
Like when we look at the PMIs, the service PMI, manufacturing get a little bit more attention because they're older
Yep.
or longer dated, but the service sector is far larger than the manufacturing sector.
Yep.
We got retail sales. They were basically flat in October for the headline, up to plus 0.03%, below forecast. The core group, though, was up 0.53% month over month. So that was a solid reading in the core group. The total on a year-over-year basis, total retail sales decelerated to 3.47, which is the smallest since May of 25, while the core group ticked up to 4.21%. So again, kind of middling out.
Mhm.
I think this report was just kind of blah, beige, middle of the road. Nobody read a ton into it.
Mhm.
I've seen a few more timely releases talking about the consumer spending right in the week or two before
Yeah.
Christmas. And it seems like, again, it's kind of comparable. I think people are always hoping for solid increases.
Yeah.
And right now it kind of seems like it's tracking in line with last year.
Mhm.
So like not maybe as optimistic as hoped, but also not falling out of bed.
Yeah.
So just kind of keep on keeping on. As far as the categories go, month over month, department stores led the way up 4.9%, and then furniture up 2.3. The laggards were building materials, garden equipment, and supplies, which is kind of a seasonal thing. You're going to do less of that in the
Mhm.
winter when it's dark and rainy. And then autos and other motor vehicle dealers. And there's some other things going on there with like the EV tax credits, rebates, what have you, those expiring or kind of some of them are coming in, some of them are coming out.
Yeah.
Yeah. So that's kind of skewed by a little bit of external forces almost. But then on a year-over-year basis, you see miscellaneous stores and non-stores. So that's like a lot of online retail up 9.5% and 9% year-over-year solid. And then on the downside, again, that building material and garden supplies. I think that's still kind of moderating from COVID when everybody was like, well, I'm stuck at home. I'm going to improve my house. I'm going to make my yard nicer. I'm going to our compliance officer had an argument with the about his pergola for a year or two that was ongoing. So you would put these improvements in, and but they're one-time things. You don't put down sod or AstroTurf 4 times in 4 years. It's once and done. But it's worth noting that building materials is the only negative category on a year-over-year basis. So that's solid. There's only one that's down year-over-year, which is nice to see. We also got kind of the final data point of the week on Friday was existing home sales. These increased to 4.13 million units in November, slightly below forecast for 4.2, but that's still the 3rd straight monthly increase, which is the longest streak in about a year. On a year-over-year basis, they fell back into negative territory, down 1. You see that's kind of, there's a little bump in there, which will make the comps a little tough and wonky. But basically they're kind of moving sideways, and hopefully you're starting to get a bid here. But again, we did have 2 head fakes that went up and then came right back down. So if rates continue to come down on the mortgages though, we'll see. That could certainly help open this up a little bit. But the median existing price is, as far as we can tell, kind of in this seasonal trend, it's down to $409,200. But it is also nice to see if you look at kind of that 12-month rolling slope there, the rolling average, I guess, to see smooth it out. The trend line has markedly slowed from the kind of immediately 2 or 3 years after COVID, where you saw home prices up like 30 or 40% in 2 or 3 years, and it continued to go up. But it's at least at a slower pace, which I know doesn't help because it's still the prices are going up. But median prices are up 1.2 from a year ago. But you can see those are really kind of moderating. And even where they are now, that's well below where they were from 2012 to 2020. So that's good to see those prices continuing. And again, for people who do own homes, this is generally the largest component of your wealth, of your assets, of your net worth. And so it is good to see those go up, even if it does make the market a little hard. I saw something today where it's, the number of people with it used to be, it was, for a while, it was a 3% mortgage. Now it's a 4% mortgage has kind of become the floor. But there's still a lot of people with a 4% mortgage out there. And so the impetus to move and lock in a rate at 6.2, 6.3 is basically you're like, you got to pay me a real high price. Otherwise, I'm not moving. So that's kind of tough, but still got to start somewhere. 3 months in a row is decent. So in the summary, non-farm payrolls fell 105K in October, but then rebounded by 64K. Basically, I'll do the government on that downside. Unemployment rate hit 4.6, which is the highest since September of 2021. But people are getting back in the labor market, so that's a good thing. Participation is up. Headline and core CPI readings were below forecasts. Core notably slowed to 2.62%, which is the smallest since March of 21. Headline retail sales are fairly muted. Again, just kind of middling along sideways. Core was up a little more robust, 0.53% month over month. And then existing home sales posted their 3rd straight monthly gain, which is good. Hoping to see some movement in that market, maybe as rates continue to come down if the Fed cuts in 26, we'll see there. But this week, shortened holiday, half day Wednesday for Christmas Eve, day off Thursday for Christmas. But we get Q3 GDP kind of tracking 3.5%, I think, which would be a great number. Durable goods and industrial production, all those are out Tuesday. Other than that, pretty quiet week. So hope you are enjoying time with your family. And happy holidays. We'll talk to you soon.